We look forward to the Senate's timely consideration of this once-in-a-generation legislation. We stand ready to continue our work together to deliver on the one big, beautiful bill, as President Trump named it himself. We're going to send that to his desk. We're going to get it there by Independence Day on July 4th, and we are going to celebrate a new golden age in America.
Hello everyone and welcome to the week ahead on Nomura Podcasts. It's Friday the 23rd of May and I'm your host, Dominic Bunning, Head of G10 FX Strategy in Nomura's Global Markets Research Department. Well, it's certainly been another big week in markets, but whether it's been a beautiful one probably depends on your perspective and your positioning. The news of the week was the passing of President Trump's self-proclaimed big, beautiful tax bill through the House of Representatives, which is also aligned with a sell-off in many developed markets' long-term bonds. These long-end yield steepenings may well be linked to fears of fiscal profligacy and concerns of inflation expectations becoming less well-anchored, a key theme to watch in the weeks ahead. And it'll be key to see how central banks react to some of these pressures. Meanwhile, the dollar continues to face broad downward pressure as the theme of US exceptionalism continues to unravel, although US equity markets have only drifted mildly off their peaks. To discuss these matters and much of the economics behind them, and also what matters in the week ahead, I'm joined by senior US economist Jeremy Schwartz, chief European economist George Buckley, India economist Aradeep Nandi, and our resident Australia and New Zealand guru, Andrew Ticehurst. Let's get stuck in. We're going to start in the US this week, although we're actually starting in Milan, where I'm joined in person by Jeremy Schwartz, our senior US economist, to talk through everything that's happening in the States. Jeremy, it's been a really big week in the US with the big, beautiful tax bill seemingly making its way through the House. There's been a lot of noise around this. There's been a lot of back and forth. As things stand, what are the kind of key provisions that you think are important? And what does it mean in terms of the economic outlook versus our baseline?
Hey, Dom, great to be back on the podcast and great to be doing this in person for the first time. So we would say there are a lot of moving parts to the fiscal negotiations, but the net economic impact is probably only modestly stimulative. First, there is a full extension of the Tax Cut and Jobs Act, the 2017 Trump tax cuts, which were set to expire. I think that was broadly expected, although it creates the bulk of the incremental deficit expansion from this bill. Then there has been additions of new tax breaks, an increase of the cap for the state and local tax deduction, as well as certain things Trump had discussed on the campaign trail, like corporate tax cuts, as well as a exemption of tips, gratuities from income taxes. That said, that's going to be offset by fairly sharp cuts to Medicaid in the current House version of the bill, which are relatively front-loaded relative to what we were expecting. So it seems like they are planning to implement a work requirement for public insurance, Medicaid, as well as kind of more frequently verifying whether people are eligible in terms of the income thresholds, which is going to lead to some reduction in health coverage and healthcare spending. So again, there's a lot going on there. The current version, we think the front-loaded tax cuts outweigh the spending cuts, but it's a fairly close call and unlikely to move the needle dramatically in terms of growth. I think the last point here is this is just a preliminary version which has passed the House. This still needs to go to the Senate, where we expect to see a little bit more pushback against some of the more stringent cuts in things like Medicaid and the Inflation Reduction Act tax credits for businesses. So it's possible that you could get some rollback of some of the kind of more deficit positive measures and lead to more of a fiscal expansion and more of a kind of near-term deficit widening. I think the final takeaway here is that this did move through the House of Representatives relatively quickly. I think this shows us that President Trump is really motivated to kind of push the Republican Party to come to a consensus on a tax deal. I think that does increase the likelihood that you do see something relatively soon, even though it did seem like a lot of the factions within the party were quite far apart from each other in its initial negotiating stance.
Well, it's a lot to kind of take on. I mean, I think one of the big things that we have seen around this has been the moves in the back end, particularly of the US yield curve, although that's also been a global phenomenon. Clearly there are these increased concerns around fiscal sustainability, not just in the US, as I say, but elsewhere. I do think, however, one thing that the US still has going for it to some degree is that as things stand, the local data pulse is still pretty steady. Inflation, for all of the concerns in early April, still seems to be holding in okay, even if there are some upside risks. As we go into next week, we've got a few survey data points. We've got the core PCE and we've got the Fed minutes. When you think about the US growth and inflation mix, and what we've seen so far, how worried are you about there being this big stagflation risk, or do you actually think the US economic picture looks okay still?
Yeah, so I think there's been a lot of evidence over the past few weeks that the worst fears from early April just are not being realized. You had the sharp shock from the Liberation Day tariff announcement that caused a lot of market stress. But as you mentioned, the data has more or less muddled along since then. There's been a lot of weakness in surveys, but we're actually starting to see some of those bounce off of their lows as the trade conflict de-escalates. So PMIs this week were positive. We expect to see some pickup in consumer confidence and UMich consumer sentiment for the final reading next week, again, off of fairly extreme lows. But I think it speaks to the possibility that growth can more or less muddle along and that a recession is not inevitable, even with the sharp shock from tariff escalation. That said, I wouldn't take too much comfort from the inflation data through April. I think it is a reassuring sign that the jumping off point wasn't too high when the tariff shock hit, but I think it's simply too early to tell what the tariff pass-through to inflation will be. So I'd say for now, you're avoiding the worst fears of a stagflation shock. In the near term, we do think that growth and labor data should more or less hold up, which is going to be positive. It's going to encourage the Fed to remain patient about resuming rate cuts. But on inflation, we continue to see anecdotal and survey-based evidence that inflation is likely to rise, that some of the tariff price increase is going to be passed on to consumers. And we expect that to start hitting the data more comprehensively as you get later into the spring and summer.
Okay, so we're not fully out of the woods yet, but at least maybe not quite as bad as we feared just a few weeks ago. Jeremy, thank you very much. Well, it's been a busy couple of weeks down under as well, with the RBA having cut rates last week and the RBNZ due on the 28th of May. Andrew Ticehurst is here to give us the scoop. Andrew, let's start with the RBA. They cut rates as expected, but we were a bit surprised by some other facets of the decision, I think. Can you talk us through what happened?
Sure, Dom. Yeah, absolutely. So as you noted, we got a 25 basis point rate cut. That was a second easing of the cycle, and that takes the cash rate down to 3.85%. But the surprise came in very dovish communication. They did lower their core CPI forecast a fraction, and their language comes across as pretty much declaring mission accomplished when it comes to getting inflation back to the target band. They have also become more concerned about the global backdrop. Could note here that their prior meeting was April 1, and that predated some of the reciprocal tariff wild volatility that we got. Final little point here, the RBA over the past 6 months or so seem to have lowered their estimate of what the neutral cash rate is. And that would suggest a case for a little more easing rather than less, of course. So some of that thinking appears to have come through in their communication this week.
Yeah, and obviously from a currency perspective, it has dented a little bit of our confidence that the Aussie currency can outperform, although there are still some things going for the Aussie which aren't, completely terrible, but certainly the relative hawkishness for the RBA does seem to have faded. We've also got the RBNZ on Wednesday. We're expecting a cut there as well, but, have you got any thoughts on how they might see things evolving?
Yeah, such an interesting compare and contrast across the Tasman. Like really good future studies, future PhD work could be done here, I suspect. So the RBNZ, they hiked a lot more, and now they're well and truly into their easing cycle. We've got them delivering another 25 basis point rate cut next week. That would take their cash rate down to 3.25 and the total amount of easing to 225 basis points. Some of the New Zealand data is actually showing signs of steadying out. after the aggressive rate cuts that they've delivered since last August. I would also say we're probably going to get some sort of dovish shift in tone from the RBNZ as well, but much less pronounced than what the RBA delivered. One of the key things here is timing. The RBNZ's last policy meeting came on April 9 after that reciprocal tariff announcement and right in the middle of the wild market volatility. So the RBNZ was already expressing significant global concerns at the time. So their capacity to downgrade things even further is a little bit more modest than with respect to the RBA.
Great. Thanks very much, Andrew. Really interesting, as you say, sort of divergence between how the central banks have acted, and we'll certainly watch very closely to see how they both move from here. Thank you very much.
Excellent. Thanks, Tom.
We're now going to talk about India, where this week brings another round of growth data. Aradeep, thank you very much for joining us this week. We'll get straight into it. Look, India releases the Q1 growth data on Friday. What are we expecting in terms of this data? And also, how does that fit in with the broader path for the economy?
So we expect that India's growth should improve from the Q4 2024 levels. So on the supply side, the gross value added growth expected to inch up from 6.2% to 6.4%. On the GDP or the demand side, we expect it to go up from 6.2 to 6.7%. But I think the internals are going to be interesting. Now, on the supply side, we've had robust winter crop output, so agricultural sector should do well. Services also we expect should do better, but industrial growth likely to weaken. Now, on the demand side, we actually expect a moderation in consumption growth, in investment growth, in export growth. In fact, what would probably drive GDP growth higher would be a sharper contraction in import growth, because at the end of the day, GDP is C plus I plus G plus exports minus imports. Look, overall, we are relatively bearish as far as our growth outlook is concerned. We are below market consensus for FY26, which is where we are at 5.8%. The central bank is forecasting 6.5%. And look, the reason why we think so is because there are some important headwinds. So urban consumption growth remains weak. Income growth has been tepid. Credit growth is moderating. There's higher global uncertainty and lower domestic demand. So it's not a great environment for private capex recovery. There are some positives. So rural consumption is slowly picking up. Lower inflation should help. India's services sector remains resilient. India should emerge as a winner in the China plus one supply chain shift. But notwithstanding, and of course, policies have become much more counter-cyclical in India, both on fiscal and monetary side. But that said, the immediate headwinds, we believe, will dominate the trajectory in the near term. So we are below consensus in FY26 at 5.8%.
Thanks, Aradeep. Now, you mentioned there a couple of things that stand out to me in terms of global uncertainty. You talk about imports, obviously. One of the big themes at the moment in the world is the US trade deals and everything else that goes with it. India has sort of seemed to be at the front of that queue, or certainly towards the front of that queue in terms of getting a trade deal. Have we got any thoughts on how that discussion is progressing and what we can expect going forward?
Well, actually, India has been engaging very proactively with the US. In fact, even before the reciprocal tariffs kicked in, India and the US were at advanced stages of deciding the terms of reference on which the tariff discussions are to take place. In fact, we recently had the Indian Commerce Minister visit the US to discuss this further. So currently the agreement has around 19 chapters. It covers tariff and non-tariff barriers. It has trade in goods and services, rules of origin, customs facilitation, digital data. Now, a lot of this, there isn't official communication. So this is more of source-based news that we are getting. I think from India's side, there is, reports suggest that India is looking to get a first, sort of a first draft, first tranche ready before the reciprocal tariff reprieve ends by July. And this means sort of getting a commitment from the US for complete relief on the 26% duty that is imposed on India, and also on the base 10% which is there. India is seeking preferential treatment, especially for its labor-intensive sectors. Now, the US is looking at lower tariffs for auto, for especially the sensitive areas like, for instance, agri. And the report suggests that India might be looking at it through the lens of, allowing some amount of US imports, but having maybe a quota or some minimum import prices. There's also news that the digital services side will be part of the deal. So I think the earlier messaging we had was that the first tranche would be agreed by September to November of this year. It's very likely, the reports seem to suggest that they are looking to get something in place by July. And I think it's very interesting that, just some time back, US Treasury Secretary Scott Bessent had said that that India has fewer non-tariff trade barriers. US isn't as much concerned on the currency manipulation side, has fewer government subsidies. So reaching a deal with India is going to be much easier. I mean, on India's side, we had heard reports that India is possibly even offering the sweetener of future-proofing the deal, which is something rarely granted. It's something known as a forward most favored nation clause, which basically means that if India agrees on a favorable tariff agreement with any other country, then it automatically also applies to the US. So I think there is a lot of momentum on the ground, which between the two countries of arriving at the deal. But yeah, I think negotiations are still underway.
Okay, well, that's great to hear. It sounds like there is still a lot of progress, but also a lot still to go. So, and we'll keep our eyes closely on those developments. Thanks very much for joining us, Harideep.
Thanks.
Before leaving Asia, we should also touch on the Bank of Korea next week, where we expect a slightly hawkish 25 basis point cut. So the cut really is aimed at mitigating some of the downside growth risks around the tariff shock. But we do note some rising concerns about financial stability. We think the BOK is therefore unlikely to provide too much of a commitment to further rate cuts. Also worth noting in Korea, a lot of the headlines around the currency and how potentially that could come into part of an agreement with the US. So that's certainly a theme to follow in the next few weeks. We're going to finish off this week in Europe. We've got George Buckley, our chief European economist, with us. So, George, just before recording this, we've had the PMI data out of Europe. And I think the main takeaway seems to be more on the prices side than on the output side. Can you give us a bit more detail on how that's influencing your thinking?
Yeah, well, of course, across Europe, we get a huge amount of PMI numbers from the flash estimate. We get them for France, Germany, the Euro area, the UK in the first instance. And of course, we have lots of activity data, price data. They don't always go in the same direction. So it's sometimes difficult to find a theme. And you can see that from the fact that the headline number of the Euro area print went down and the one from the UK went up, maybe because it went down so much the previous month. One thing you can say, which is consistent, as you rightly say, is the price numbers. The output price data have weakened across the board. And obviously that's something which central banks will be relieved to hear. It may be related to the fact that energy prices have come off a bit. It could be because wage pressures are loosening a little bit and labour markets are loosening. But whatever it is, it's encouraging news, and it could mean could put downward pressure on inflation at some point.
Yeah, it's interesting you mentioned that because we do this week coming up have some inflation data out of Europe, I guess, for May. Do we expect inflation to look pretty soft? No impacts from tariffs, etc., kicking in just yet?
So our preliminary forecast is for it to either remain the same or a little bit down. And I think the big question is that for all European countries, we saw a big uptick in airfares in April. Now, I suspect some of that might be due to a late Easter. But, look at what the Bank of England said in its monetary policy report recently. It mentioned that airfares were going up because there was a huge amount of demand by households for holidays. And I suspect that's probably true across Europe as well. So the big question for us is that airfare increase, is it temporary? Is it going to drop out of the May figures? Or is this reflective of the fact that people are wanting to spend discretionary spend, and that's pushing up on demand and therefore prices?
Yeah, I mean, it's certainly a bit of a conundrum, I think, for many policymakers. But at least, I guess, in Europe, to some extent, the lack of inflation pressure makes life a little bit easier, as you say, for the ECB to some extent, and certainly maybe provides a little bit less risk in terms of, back-end yields blowing out like they have done elsewhere. If you've got the stagflationary problems that many have, Europe doesn't quite seem to have that issue. It seems to be just more of a broadly slower growth, slower inflation environment. So the ECB probably still has a few more cuts left in its locker.
Yeah, I think there's a few more cuts to go, and I think one other point about inflation is that if you look at the ECB account, which was published just a few hours ago, they were talking about things like inflation expectations. Those are really important to monitor. And next week we also get some inflation expectations data from the Consumer Expectations Survey, and that will tell us they have been going up. I think they've been going up in a lot of places, not just Europe, but the UK, the US. So I think there'll be an increased focus on that as well. I don't think that will derail rate cuts. We've still got 3 more. I think we should be getting down to 150 by September from the ECB. Now, I think that's probably going to be 50 basis points below where we think the bottom of neutral range is. So, I think there's room more to cut, and even some of the hawks on the governing council are talking about the fact that rates can go below 2%.
Perfect. Thanks very much, George. Appreciate your time.
Thanks, Dom.
Well, that's it for now. Thank you again for joining us at Nomura Research on the week ahead, edited and produced as always by John Dalton. If you've enjoyed the content, please do like and subscribe to Nomura's podcasts, whether that's on Apple, Spotify or SoundCloud or any of your usual podcast providers. We'd love to hear your feedback, so please do write a review and share this podcast with anyone you think might be interested. You can also check out nomuraconnects.com for more of our research and updates. That's it from me. Thanks very much and good luck in the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura. Connecting markets, East and West.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision, and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice, nor is legal, regulatory, accounting, or tax advice, and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers, and disclosures, please visit Nomura Connects at www.nomuraconnects.com.